Hey, what's up everyone, and welcome to the School of Personal Finance. So here we are, the end of September. The stock market is making fresh lows for the year. Big tech has started to roll over. There's blood in the streets. People are panicking. Just feels miserable out there. So in this video, I'm going to try to take a step back, coach you through this, talk about expectations, some things that maybe you should be looking to do, just trying to keep you from freaking out and panic selling at the bottom of these markets. Now, again, nobody knows when the bottom is, so all of this stuff is just my opinion. None of it is financial advice, but it's always good to just listen to others, try to have a clear head when looking at this stuff because it sucks losing money. So we're gonna talk about it in this video. All right, let's get to it. All right, now just my quick disclosure, none of this is personal financial advice. This is all just my opinion. Everybody's situation is different, so obviously I don't know what's going on with you and what would be the right thing for you to do in this current environment. Go check out schoolofpersonalfinance.com and download my free budget template, which is awesome. You could go in there, you could put in all of your expenses. There's all the categories. You could change it around to customize it to your spending styles. You could put in your projected expenses for the month and then compare it to your actual spending. I like to use it just to get a baseline of what my monthly expenses are and then go back after I track where my money goes every month using apps like Mint or Personal Capital, and then go in and put in actually how much I did spend for the month. I always talk about how it's the first thing you need to do when creating your own financial plan, and that is turning the lights on. So go download that template. It's over at schoolofpersonalfinance.com. So here we are. The NASDAQ is down over 30% year to date. The Dow's down like 20%. The S&P 500 is down like 24%. It is just ugly out there. So now we've had a tremendous run up until this point, but it always feels so much worse losing money than it does feel good making money. So we all do the same thing. We look at our account statement, we look at our high water mark, and that's where we judge everything from. So as we're making money, it feels great. And then we see maybe we hit $300,000 in our 401k. And that's always the number that sticks in our head. So when we get a statement, which we're going to get very soon, and it shows that our account values are 25% below that, you want to fall over and have a heart attack, right? It just feels like, oh my God, I just lost all of this money. But the reality is that markets, they do go up and down. Economies, they go through cycles. It's not all just up. That's why there is risk to the stock market, because we go through these cycles and they're very, very hard to time. So when you're investing for your future, when you're investing for the long term, you just have to be aware that these things are going to happen and that they feel like crap when you're going through them. And there are going to be people out there that are going to say, this time is different. Get your money out before you lose any more, because we're going to hell in a handbag and everything's going to go to zero. And then people panic. And right when we hit that capitulation point, when everybody panics and gets out, that's when the market starts to turn around and go higher. We've seen it in 1987 when we had a stock market crash, 2001 when we had the dot-com bubble burst. We saw it in 2008, 2009 during the Great Recession, and there will come a point when we see it again during this downturn. The truth is, though, nobody knows how bad the pain will get. So if the NASDAQ is 30% down, the S&P 500 is 24% down from its highs, what's to say that it can't go down another 10%, another 15%, another 20%? And it's just going to feel more and more painful the whole way down until enough people reach that point where they just throw in the towel and they say, I've had enough of this crap. Or they're going to try to time it and they're going to say, you know what? I know the markets are going down further, so I'm going to sell right here. And then I'm going to go ahead and I'm going to buy back in a few months later when things start to get better. But that's always a bad idea because it's just so hard to time. As things continue to go down, you make the rationale in your head that it's just going to go further. I'm going to wait a little bit longer. And then as it starts to go back up, you say, no, it's going to turn back down again. I can't buy it here. I got to wait for the downturn. And it just becomes a very hard game to play. That's why many successful investors out there, all they do is they just dollar cost average in. They're not trying to time the market. So when you get your paychecks and you put money into your 401k every 2 weeks, they're just consistently adding to the market. And in my opinion, that is a great way to go, especially when you have 10 years, 15 years, 20 years, 25 years until you're even going to be touching that money. You can't panic right now and say, get me out of all these risky assets, even though it would feel really good to not be holding any stocks, any houses, anything out there right now, any gold, any crypto. You don't want any assets right now because everything is just plummeting. And a lot of it has to do with the Federal Reserve, right? The Federal Reserve, inflation, they are raising rates right now, and they're trying to to squash this. And the only way they're going to do that and bring prices back down to normal levels is by killing assets. So as the Federal Reserve raises interest rates, what it does is it crushes the economy. It brings down asset levels because now we cannot borrow money at reasonable rates anymore. So businesses that rely on debt to grow, their valuations, they get killed. And that's exactly what we've been seeing since the Fed started raising rates. So growth companies that don't have earnings, that borrow to grow, they've just been obliterated. But it's going everywhere. There's been nowhere to hide during this downturn in the market. If you were a conservative investor who invested in bonds, you've gotten killed as well, because as interest rates go up, the value of the bonds go down. So we're just in one of those environments where there's been nowhere to hide except for the US dollar. The US dollar has been very strong compared to other currencies. And you can make the argument, well, your dollars are getting inflated away, but at least they're not losing a ton of value right now like every other asset class that exists right now. So even energy and oil and commodities, those things have rolled over and have come down in value. So a lot of people think that inflation has peaked and now we're heading downwards and that the Fed needs to stop, that they're crushing the economy and they need to stop raising interest rates. And I kind of fall in that camp too. So maybe one more 50 basis point rate hike and then call it quits. That might be nice. And as soon as the economy, as soon as the markets start to see the Federal Reserve pivoting and slowing down this pace of raising rates, as soon as they give the smallest hint of that, we are going to have a rip your face off rally where the markets are just going to explode higher. But it might be short lived. We don't know what's going to happen and we don't know how long this cycle could last. So I don't think that we're going back to easy monetary policy anytime soon. I think that the Fed will eventually stop and take their foot off the gas. But after that, it could be a very long time before stocks get back to the values that they were just 1 year ago. So you have to be prepared for that. Your expectations have to be realistic and you have to come up with a plan of what you're going to do from here. So I've been talking about being patient all year, right? If you go back and watch my videos, I've been talking about raising cash, paying off debt, and being patient, and none of that has changed. So if you have any variable rate debt, any credit card debt, home equity lines of credit, anything that is going to go up, the interest rates are going to go up as the Fed continues to raise rates, you want to pay that stuff off, right? That has to be first and foremost. Get out of all of your bad debt and revolving debt that is subject to these higher interest rates. The second thing is cash. One good thing about interest rates going up is that we're starting to see some reasonable rates on savings accounts or 1-year CDs or treasury bills. The I-bonds still have a very high interest rate. So there are safe places to put money right now that you're going to need in the short term. So any money that you're going to be using over the next 1 to 2 to 3 years, you should have in these cash equivalent type of investments. So like I was just looking at Capital One 360 is paying 2.15% on just a high yield savings account. You could get a 2-year treasury over 4% right now, where you buy, a 2-year treasury bill and it has a very appealing rate. You're starting to see 12-month CD rates in the mid 3s and creeping up from there. So there are places to put some cash right now where it's very safe and secure and you at least get some kind of return on your money. We can make the argument that it's not keeping up with inflation because inflation is still, over 8% right now as we speak, which is ridiculous. And that's why the Fed keeps on increasing interest rates. But just for safety, security, knowing that your money is going to be there, those are good places to park money right now. And you want to have that emergency fund. You want to be building up that cash right now where you feel very secure as far as cash flow goes, because this economy, it could get worse and there could be more job losses. You want to be in a position where you don't feel stressed about your personal finances. But with that said, you still want to be investing. So as far as your 401k or your 403b and your retirement plans, your Roth IRA, now is a great time to be trying to plow money into those things, because we're going to look back on this 5 years, 10 years from now and say that this was a good opportunity to be buying. So yes, it could get worse before it gets better, but don't stop. Don't stop your contributions just because the market is down 25%. If anything, flip the script and try to increase your contributions when we're down here. And we might have years of being down here. So you might have, 2023 as well, where if you could max out your 401k, your Roth IRAs, traditional IRAs, whatever account you choose to invest in, try to do it. It's a good time to be doing it. A couple things you could consider during a terrible market like this, and again, it depends on your situation and your financial plan, but the first first one is doing Roth conversions. So it's always great to do conversions in a down market, right? Because if you say, for example, you had 10,000 bucks in a traditional IRA, and now that 10,000 is worth $7,500. If you convert now, you'll owe taxes on the $7,500, and then all the growth from here on out will be tax-free in the Roth IRA. So now when you do a conversion, you pay taxes in the year that you do the conversion. So you have to look at what your individual tax brackets are and if that fits into your plan for this year. But when the markets are down, it's a good idea to look at that at least and see if it makes sense for you. Another thing could be to look at making Roth contributions. So in your 401k, if you have a Roth 401k option, now could be a good time to do Roth contributions instead of the traditional contributions. Again, it depends on your tax bracket and if it's worth getting the tax deduction now compared to getting the tax-free money to grow forever, but paying the taxes now. So switching from traditional 401k to Roth 401k through the end of the year, that's something that you could look at as well. Another thing to consider is if you have brokerage accounts and if you have losses in individual stocks or ETFs, doing some tax loss harvesting, we call it, where maybe you have a position that you're down pretty big year to date. You go ahead and you sell out of that position and you take the loss so that you have that loss to offset against some of your income. That's something to look at as well. All these portfolio, strategies and maneuvers, there are things that you could look at during these down markets that might save you a little money or make some sense for your long-term planning. But all of these decisions, they are so personal. It really does depend on your situation. If you have a very stable job and your spouse has a very stable job and nothing's really changing for you in this economy except that your portfolios are getting annihilated right now, then you should really just be sticking to your plan. But if you're in the situation where maybe you are at risk of losing a job or maybe you are carrying some debt and it's just not as certain for you going forward, then I think you need to be very careful right now and you need to be building those reserves and just being on very stable ground, not carrying the debt, right? This is not a time to be leveraged, making bets on investments where you could blow yourself up. So I'm definitely in the camp of safe right now, secure. Opportunities will be there for a while for you to take advantage of these things, but just make sure you don't put yourself in a situation that it's hard to climb out of. So I think 2023 is going to be a challenging year as well. I mean, maybe we'll rally. Maybe fourth quarter could actually get a nice bump up after we have the midterm elections. Who knows what could happen? So that's the thing, is that nobody ever knows. That's why you always want to be a buyer. If you're in the situation that you can be, you want to be a buyer of these big downturns in the market, because eventually we will cycle through, even though it doesn't feel like it now. And again, things might feel a lot worse a week from now, a month from now, who knows? But at the end of the day, over the long term, the US economy will be okay. We will continue to grow. These companies that have real earnings, that are great companies, they will come back around. They will start to grow again. It just might be a while before we see that day. So hopefully it was helpful, me kind of sharing my thoughts and rambling on about all this stuff and, trying to ease your mind a little bit. But again, I do think that the market, that the economy, that everything feels terrible right now, but it's always darkest right before the dawn. So it's not going to stay this way forever, and things will change and we'll get through this, but we just don't know when that might be. So be safe, be secure, keep enough cash on hand to weather the storm. Don't make any big moves right now, and we'll see where things go from here. All right, everyone. Thanks for watching. I will see you again in the next video. Thanks.